Hey guys, it's Big Mike, and like always, I'd like to thank you for being here today. Today we welcome back Morad Askar, better known as Futures Trader 71, for yet another webinar, this time talking about scalping techniques. There's actually a few bullet points that he wants to cover today. Those include the good, bad, and ugly of scalping, fundamental requirements for proper scalping, scalping timeframes, why not all products scalp alike, tape reading and its uses, basic risk and position management for scalping, and the importance of tracking your efforts, as well as exaggerated impact of trading errors while scalping. At the end of the webinar, we're going to give away 5 autographed copies of a book called The Chimp Paradox by Steve Peters. The book was selected by FT. He's going to autograph them. And in order to win one of those books, you're going to want to pay close attention to what FT has to say today. The quiz questions at the end for 5 copies will be based on the material covered today. I will ask you for your BMT username, and that's how I will get in touch with you when the webinar is done if you're one of the winners. So please have that ready to go. The webinar is being recorded like always. I'll post the recording on YouTube sometime tomorrow. If you're watching it on YouTube and you like what you see, please do us a favor and give us a thumbs up. You can ask questions, and I'll stop every now and then and ask if FT wants to take questions or if we're going to hold them until the end, and we'll do our best to get everybody's questions answered today. All right, with that, I'm going to turn things over to FT and we'll get started.
Very cool. Thanks for having me on.
Yeah, thanks, man. Hey, did you want to take questions as they come, or do you want to hold them until the end?
I prefer as they come because then it makes it easier, but you really have to stop me because once I get into the flow, I kind of lose it. But,
all right, no problem.
So I'm not going to be looking at the questions thing because I need to kind of keep my thought going. Just getting old, I guess.
No problem. All right, thanks, man.
Yeah, this is actually a topic that's been requested so many times, and just this is the first time I'm covering it. Now, I'm going to be upfront, and I'm going to say that I'm going to try to do a demonstration of how I scalp, and I'm using the NinjaTrader platform. The reason I'm using the NinjaTrader platform because we just completed an upgrade of a tool that I've used for years and years and years called the Trade Analyzer, and the newer version or the updated version was created in Ninja first, and then it's going to be converted into our S5 Trader platform, which is basically OEC Trader or the Gain Capital platform. So I'm using it, and I'm just not a Ninja user, and so I hope that works out. So I'm taking a significant risk with that portion of the talk. I'm just trying to be upfront with it. I have to start with a risk disclaimer. Derivatives trading involves substantial risk of loss. It is not suitable for all investors. Past performance is not indicative of future results. The statements made during this presentation are my opinions and my opinions alone, and are subject to change without notice. Okay, so let's start out. The good and the bad, the good, bad, and the ugly of scalping. So there are certain portions of scalping that make it attractive. There are certain portions that make it less attractive. The good part about scalping is the reduced duration of exposure. The longer you're sitting in the market, the longer you're extending your risk and a potential for an adverse move. The market could sit in a long period of time and not go in any direction and all of a sudden move against you. Scalping is about getting in and out, and nibbling on the small, the very, very small, maybe even the smallest rotations within a non-trending period. The market, according to a study I did, It's getting dated now, about 70 years ago, on 1,400 days of data on the S&P. The S&P trends approximately 12 to 18% of the time tested. The time tested was during regular trading hours, and the trend is defined by several factors, including how the bars are related to each other, how they're printing related to each other, and so on. So the market trends less than it sits in consolidations lately. That doesn't seem very true, but we don't always have the volatility that we have now. So reduced duration of exposure is a key element of scalping. Continuous action. A lot of people don't like to sit in front of their computer for hours and hours and hours to fire off 2 trades on the day, and that's all the opportunity you have. Generally, there are more opportunities in any given swing. You might have a move like today. What did the market cover today? Approximately 30 points or more. Within that 30 points, for scalpers, there could be 100 or 150 points, I'm just guessing, of opportunity, because as you buy the low and sell the high, let's say, while the market is doing that, it is actually swinging in 1 to 3 to 4 point rotations, and a scalper can grab a whole bunch in the middle of those little rotations. So there's a lot more opportunity for gain and loss while you scalp. It's a great way to learn to enter and manage longer time frame trades as well. I started out as a scalper. Those of you who know me know that I came on, I moved from an engineering background, a construction manager background on very large projects, 30, 50 to $300 million projects, into trading, and I came in as a NASDAQ SOS bandit or SOS scalper in Florida, and we would trade huge volume. Some of the guys that I learned from were trading 8 to 15 million shares a day in Microsoft, a good portion of that stock's daily volume. So that's my introduction into trading, and when I moved to futures, I was a momentum scalper, an inter-commodity momentum scalper. So all I did was watch different markets, and I had a good feel for the relationship between them, and I took advantage of mispricing opportunities on very, very short time frames across those markets. And the scalping knowledge has helped me now with the volume profiling and all the stuff that I've talked about on BMT in the past, on my daily trader bites and so forth. Scalping has helped me find better opportunities or better areas to enter, because essentially every trade starts off as a scalp. The bad about scalping: a higher cost of commissions and fees. So commissions and fees now eat a much larger portion of your net return or net profit or loss. So all of a sudden, if you took $1,000 loss on 3 trades, maybe it's $1,015. But if you took $1,000 loss on scalps and you traded 100 times that day, all of a sudden it's $1,600 or $1,700 in losses. So the commissions and fees is a big, big portion of this, and I do focus on that a little bit just to share with you guys some of the information that you need to know with regards to how commissions and fees work, so that you can more intelligently approach this if you so desire. This is also highly dependent on connectivity and infrastructure. I'm in Chicago. Until recently, I sat right in the Chicago Board of Trade building. My connectivity to my clearing firm, or to the servers that I'm using through the S5 Trader, are running at about 5 to 6 milliseconds. That's the latency. That's how fast one packet leaves and comes back. It's not a very good measure for latency, but a ping test gives you a general idea. So that's something you have to deal with, and you know, the connection to that to the exchange and everything else is high grade. I cannot afford to have a network failure while I'm trading. It also requires fanatic discipline in taking losses. We'll talk about that later. It's great to capture 2-3 ticks here, 2-3 ticks there, but if all of a sudden a trade gets away from you and you allow it, and it costs you 30-40 ticks in one trade, and those 30-40 ticks took you all morning to make, that's not a sustainable business. Your competitors, the ugly part about this, your competitors are often using faster connections, better news feeds, analysts. There's just a lot that they're able to take advantage of before you might get a clue that, hey, this is failing or whatever. This space has been dominated by predatory HFTs. So from 2005 or so, I think it was 2005, late 2005 to 2006, it became really obvious that there were just so many machines that are taking over the scalping space. And they're doing it by using techniques such as quote stuffing, spoofing, loading the book, flipping the book, all kinds of crazy things that cause scalpers who are going strictly off of the depth of market to throw you off. And that's really the worst part of scalping. And with the recent introduction of Rule 575 on the CME, we see less of that. You've noticed that the dome, or the depth of market, is a lot thinner in the S&P, that it's more fluid. The rule went into effect about the same time the volatility started, so it's very hard to tell what's what. I believe the rule went into effect September 15th. This is mostly not feasible without exchange membership or volume, some sort of a volume rebate structure. So if you're in the equities space, there's a volume rebate system that you can be a part of. At least the last time I checked, I'm not sure if it's still going, for liquidity providing or liquidity take. You get penalized for liquidity taking. So you basically act as a market maker in that environment. Also, the leverage required in order to do this for a living and actually have a substantial return on the time and risk invested, the leverage required is very high. I'll give you an example. When I was trading at my peak, when I was trading the DAX, I had approximately 1,800 to 1 leverage. If you look at a $500 margin on the S&P, at current prices, the leverage represented by those firms that give you that, it's 190 to 1. 190 to 1. I had about 10 times that. So essentially I was trading the S&P for $50 per contract. Of course, I don't suggest that. Leverage is a very, very dangerous thing, and it's actually the biggest issue with futures trading currently. As far as boy, I have this going backwards. As far as the fundamentals for proper scalping, your PC and the equipment that you're on is very, very crucial to this process. Your scalping PC must have minimal software on it. It requires processing power. You do not want a PC that's laggy, that's processing or backing up or watching YouTube or whatever. Your scalping PC has to be a very, very efficient PC. Generally, I have an image of my trading PC that goes back on every 6 months, a clean image, and on that image you just have the operating system, the latest version of the trading platform, and that's it. And nothing else on it. Preferably your scalping PC does not have charts on it. We traditionally use a separate PC for charting. The PC I'm talking to you on is my charting, internet, S5 chat room, Twitter, all that stuff. But my trading PC is a completely separate box, generally on a completely separate connection, and that doesn't access. I don't access any browsers with it. I don't get on the internet with it. It just runs my trading platform. Your scalping PC never accesses the internet and does not use a firewall or antivirus software that do this at your own risk. I don't want a firewall or antivirus software to get in the way of the connection. Also, the ports on our router here at the office are all closed except for the specific ports needed for internet access and access to the production URL or IP at the clearing firm. The network. DSL connection is preferable. The reason the DSL connection is preferable is because DSL generally has a lower latency than cable. Latency is just a measure of how quick a packet leaves and comes back to your PC. Cable connections are generally like your water line outside. Different people can tap into it, and so even though you're buying a certain amount of bandwidth, the more people that connect to it, the slower it is. It's a variable connection, whereas a DSL generally is a point-to-point connection. And is much more stable for trading in my experience. DSL gives you a consistent latency, whereas cable and other products generally have a fluctuating latency. Cable gives you much more bandwidth, it gives you more speed, but that's not necessarily important for scalping. You just need something that is consistent. A lot of the scalping is going to be done on how the market feels to you, and if that fluctuates, it tends to muddy the waters a little bit. Bandwidth is less important than consistent low latency. Connection. The network also has to have connection that scalping PCs on. It cannot be used for Wi-Fi or another purpose while trading. In other words, while you trade, you don't want someone in the next room downloading the latest Netflix movie or whatever. You want to make sure that you have all the bandwidth available to you. Wired connections only for trading PCs. I don't ever trade on Wi-Fi. I don't care how good a Wi-Fi connection you have. Wi-Fi is variable, and it's subject to a lot of protocol checking and rechecking and so on. It's a wired connections only for my trading PC. Power. Everything from my PC to the main monitor to my PC, scalping PC, and the main monitor to my charting PC are all on a battery backup, so you can pull the plug on pretty much anything on the network, and I'll still have the connectivity, which means that your ISP modem, your internet modem, your router, if you use a switch, your PC, the main monitor on your PC, all of those need to be on a battery backup that gives you about 5 minutes to exit. And the way we test that is we connect everything, and then we just shut off. We go to the main breaker and shut off the power to the office and see what goes down, and then we know if it's hooked up properly or not. Execution is very important. You must be on a stable trading platform and through a broker who's quickly responsive in case of emergency. You do not want to be on a service where you call and you're put in a queue and you have to wait and you have to listen to music and all that stuff. That's not going to help you when you're scalping. You've got orders all up and down the market, and you've lost connectivity. You want a broker who will answer as quickly as possible and has the risks, some sort of a risk monitor in front of them, and is able to cancel out all your orders and flat your positions immediately while you figure out what happened. You know, a lot of the bigger brokerage houses, you're put in a queue and there is no button you can press to get on an emergency line and be put through to a broker. Use a broker who specializes in the type of market you trade. So, for example, if you're scalping futures, then use a broker that specializes in futures and has direct futures connectivity. If I'm scalping equities, I'm going to go to whomever has direct connectivity. At the time I was scalping equities, I used Hold Brothers, Schoenfeld, those kinds of firms. I've never used E-Trade or Thinkorswim or Interactive Brokers or TradeStation for any scalping. Generally, the connection is netted. It's slower. It's not designed for this sort of the sort of connectivity you need for scalping. You need somebody who gives you direct market access, DMA, whether it's for futures or for equities. Fee structure. That's the next big piece. In general, your fee structure is broken down into the following components. Now, I'm covering futures because I'm a futures trader. I do kind of vaguely remember what kind of cost structure there was for equities. It's been a while. It's been let's see, 10 almost 13 years since, or 14 years since I've scalped equities. I don't remember those things. But I'll use futures as an example. Your fee structure is made up of exchange fees, regulatory fees, which are very small, a software fee in case, depending on the software you use, some platforms have a transactional fee, some have a static DOM fee, and so on. And then there's your broker and clearing commissions on top of that. I'm not going to discuss broker and clearing commissions because that is highly dependent on your volume, and it's much more to do with the broker's cost structure, their clearing firm agreements, and things like that. I'm going to talk about those things that are standardized, which is the exchange and regulatory portion. What are these fees, in case you didn't know? Fees for non-members trading the ES, the S&P futures, as an example. The clearing fee is 40 cents per side, so 80 cents per round turn. The Globex fee is 75 cents per side, $1.50 per round turn. And then there's an NFA fee of 1 cent per side. This was 2 until the first of this month, and now it's 1 per side or 2 per round turn, in and out. Round turn means getting in and getting out, what would be the cost per contract. Total per round trip for non-members is $2.32 for exchange and regulatory fees. Again, broker and clearing commissions are dependent on volume. Let's compare this to what it would cost for you to be a leasing member. So you can be a non-member, you can be a leasing member, you can own, you can be a part of an ECM. An ECM, which is a corporate membership, but let's address the three main categories: non-members, leasing, and owners. Again, this is why. What does this have to do with scalping? It has a lot to do with scalping. Your cost structure is part of your business plan for scalping, and I'm going to cover this in the next couple minutes. The clearing fee for leasing members is 21 cents. If you recall, right here was 40 cents for non-members. The Globex fee for leasing members is 25.5 cents per side. Over here it's 75 cents per side. So you can see that there's a fairly substantial disadvantage to non-members to be very active in the market. There is no NFA fee for members. Once you're a member of the exchange, I'm a member, I've been a member of the exchange for quite some time. I don't pay NFA fees. So the total round trip cost for one ES contract for a leasing member is anywhere between 93 and 42 cents depending on volume. The Globex fee drops off as you trade more, whereas here it's $2.32, so it's $2.32 per round turn versus 93 to 42 cents per round turn. And then as a leasing member, you have to pay $325 a month to lease that seat. There's a $2,000 application fee. So you can see how that cost structure changes dramatically. Okay? Let's move on to the owners. So I'm an owner of a seat, and my cost structure is going to be very different than a non-member and a leasing member. Clearing fee for owners, 9.5 cents per side. Okay, so 19 cents a round turn. Globex fee is 25.5 cents per side. And there is no NFA fee, so per round turn as an owner, I'm trading at 70 cents to 19 cents per round turn. Okay, that's exchange fees only. There's still a broker fee. My broker has to get paid. They're also taking the risk of having my account on their books and so forth, and so I need to pay them for that. There's a purchase fee. The current price of an IOM membership is $75,500 to own, plus there's $2,000 for the application fee. So I've taken, in the next slide, I've taken the 75,000 and I've said maybe let's look at someone who owns a seat for 3 years and then sells it back. But by the time they sell it back, the price of the seat has dropped to $60,000. So we'll amortize the $15,500 and then compare apples to apples what it costs per month for the first year and then 3 years for the different membership structures. Why is this important? It's because when you're scalping, you're generating a lot of volume. And if you're generating a lot of volume, cost becomes a very, very big part of it. So I'm assuming 2,000 round turns per month for all 3 categories. These are the costs for non-members right here. So the first year, the cost for trading 2,000 round turns per month costs $55,000. For leasing members, it's $28,000. For owners, it's $24,000. But remember, the owner also owns the seat. After 3 years, the cost to the non-members $167,000, and leasing members $80,000, and an owner $68,000. Again, the owner owns this seat, so they get the benefit of that. Are there any questions about this?
Yeah.
I know I'm covering a lot and very fast.
Yeah. Okay. Couple questions. Jesus wants to know what happens whenever you're buying or leasing a seat. Are you automatically considered a professional, which would change your CME fees?
Yeah. In that situation, you start to. You are a professional by definition. You don't need a seat unless you're a professional. However, there's also a break on fees for members, so you need to look into that. It's not something that I know a lot about. It's something that my partner, Anthony, kind of handles for me. Once you're designated as a professional and you're a member, there's a way to benefit from that as well as far as the fees are concerned.
Okay. Jeff wants to know, and I saw another question earlier, basically what the difference is, or how do you know that you're a scalper versus someone that's just actively day trading?
Actively day trading is very broad. I could be actively day trading, but that could mean 10 trades in a day. I could be active related to someone who just puts on 2 trades a day. So actively day trading is a relative term. Scalping is a lot shorter term. Scalping is essentially taking very, very little chunks out of any given move, and generally it's in the several ticks per trade, and you're just essentially it's almost like surfing a small wave as opposed to somebody who's waiting for a big wave to kind of ride for a long period of time. So they're very, very different. As a scalper, you're definitely an active trader, but somebody who trades 10 times a day could be active relative to someone who only takes 3 trades a day.
Right. All right. Last question. Jeff wants to know if you apply and pay the $2,000 application fee, is there a chance that they decline you for some reason and then you lose the $2,000?
Yes. So the application fee is non-refundable and I'm using the CME as an example. There are other exchanges that do or do not have fees or memberships. The $2,000 covers a very thorough background check, FBI verification. I think there's a fingerprint. No, there's no fingerprinting, but it goes through your references. It goes through your employment history. Becoming a member of the exchange, you have to go through a pretty thorough process because membership also gives you access to the floor. You can become a floor trader or floor broker, and you're transacting in very, very large notional values. So they want to make sure that you have a pretty good credit history, no criminal record, good references, all that stuff, and that's
right.
Part of the administrative fee that they collect. So they can take the $2,000 and still turn you down.
All right, I lied. One more question, then let's move on. Are there requirements for like residency or anything that would prohibit people outside of the States from being members, like Canada or overseas?
Not that I'm aware of, actually. I believe that as long as you're not what's called an OFAC nation, which means essentially you're limited because your country's designated
Right.
as a risk
Blacklist.
to the U.S. or whatever.
Yeah.
Yeah. I believe anybody can be a member other than those people.
And you don't need to pass. You don't need to pass any of the Series 7s or anything like that to be a member.
No, not at all. Not at all. You can be a member. It has nothing to do. The Series 7 and those licenses are only required when you need to be regulated, which means you're handling other people's money or advising other people on what to do with their money. That's all. It's not for trading your own account generally.
Okay. Yep.
Let's see. So that's covered. Scalping time frame. So that ties in with the question you asked about how active you are. In order to scalp, it's really important to define what I call your sandbox limits. So if you're going to play in a sandbox, you need to know where the edge of that box is, and you need to define that. Even if you're not a scalper, you need to define that for whatever trading style you use. What time of day will you be scalping in? What time frame will you use to get an overall feel for duration, for the duration you're scalping in? Are you going to use 1 minute bars, 3 minute bars, 5 minute bars, whatever? What times of day should you avoid? There are times where it really doesn't pay to scalp because there's a lot of control in a higher time frame. There's a lot of control that other groups take during those times. I'll tell you, one of those times is actually right at the open. Right at the open, you have a much higher time frame players coming into the markets, people who have worked out their position on the daily information and come in and step in and do their business early on. You can easily get run over during those times. You know, do you trade right before a number? Do you trade right after a number? How soon after? There it is. How soon after a number or news release should you resume scalping? Also, scalping generally involves low periodicities. 1, 3, and 5 minute are the most common that I've seen if you're using minute bars, which is the most comfortable thing. Personally, I don't like time-based bars. I don't think the market is encapsulated with time except for the time it opens and closes. But in general, throughout the day, I'm more interested in how much it moves or how much volume is causing a move rather than a period of time. So I use volume bars, Renko bars. In general, I generally keep a higher time frame chart, which is 5 to 12 times my scalping chart to see the bigger picture. So if I'm looking at a 3-tick or 2-tick Renko, I'm keeping a 15-minute bar chart to see what the big picture is so that I'm not losing sight of what's happening overall in the markets. Not all products scalp alike, and that's so let's just go over that real quick. How do you know which products to trade? Scalping indices. Generally, equities and equity indices are the most common scalping product. That's true. I started with equities. I moved to equity indices. I've scalped treasuries under certain circumstances. I've traded, for example, the U.S. bond. On economic releases, that's what I used to trade on non-farm payrolls because it has a much higher tick, $32 a tick basically. But indices are the most popular. They're driven by underlying assets that are easy to understand. I can understand that the S&P 500 has 500 stocks. I can look up those stocks and I understand what they're doing and I understand how this product moves. It's easy to figure out what could be driving this market. They respond to but are not directly used as an intervention tool by a government entity. Generally, when the government interacts with the market, it doesn't come in and buy S&Ps. It comes in and it decides on fixed income assets, treasury assets, to do its intervening. It's controlling interest rates. It's controlling, QE is a purchasing program of certain dated treasuries, certain durations. So it's not a direct intervention, but because there is that intervention, there is a fallover effect or spillover effect into indices, but it's not direct. In general, there are a variety of equity indices of different styles and that are active during different times of the day. Some of the most popular are in the U.S. ESNQ, Russell, and Dow. So the ESNQ on CME, Russell is on ICE, and the Dow is on the Board of Trade. In the Eurozone, you have the FDAX, Eurostoxx, CAC 40. FDAX for Germany, Eurostoxx 50 is for the entire Eurozone, and CAC 40 is in France. The UK, you have the FTSE 100 and FTSE 250. In the Asian time zone, you have the Nikkei 225, which is also on the CME, the Hang Seng, and the ASX 200, which is in Australia. The other product that you can scalp is the treasuries. The most popular scalping tool in treasuries or fixed income, in my opinion, is the U.S. 10-year note and then the German Bund. The German Bund is worth 10 euros per tick, which is about $12.50 or so at current exchange rates. I always prefer to trade Europe, especially when the euro is at $1.30 to $1.40. Because you earn in euros, you pay commissions in dollars, and so as the euro went up, my commission cost would go down relative to what I was earning. These products are heavily influenced by central bank and political policy, so that's really important to note that movement in these products could be very sudden and very and push very, very far. So when you're scalping, when things start to look like they're really running, you have to make sure that you're able to click out and not fight the market, fight the market while it's being pushed by, the Fed or the ECB or whatever. The underlying for these products, the underlying asset for these products is based on a complicated asset. It's based on durations and maturities. For example, if you thought that the yield curve is going to flatten and you want to take a position in the 2-year and you believe the 2-year is going to increase by 0.5%, it's very hard. It's very hard to compute what the equivalent December 2-year futures contract is going to be priced at. It's very difficult to figure out what this duration and what the maturity will be that you're trading. It's almost like those people who trade the spread or scalp the spread or scalp the outright have kind of a general rule of thumb idea, but there's really no way to know which cash treasury products are controlling the future. These are often traded by other participants as part of a spread position that is correlated with yield curve expectations. So when you're scalping treasuries, just know that a lot of times the volume that's going through is not one-sided volume, that volume is being offset in another treasury duration. In other words, the 1,000 lot that just traded in the 10-year could be trading against an opposing position in the bond, because the person putting it on is trading what's called a NOB spread, which is notes over bonds. Again, I won't get into that. That's just what complicates these a little bit. The other product that's popular to scalp, energies. Most popular energy scalping products, the NYMEX crude oil contract. A lot of people trade that, the CL or the QM, which is the mini product. These products are heavily influenced by direct supply and demand and the reactions of producer nations as well as geopolitical situations. For example, if you look at the crude oil chart, you'll see about a week or a week and a half back, we had about a $4 drop in crude oil. And generally, that you can't explain that based on a fundamental move. But you look a little more deeply, and the expectation was that Saudi Arabia would want to reduce their production of supply on crude oil, but instead it put out a statement that it's comfortable with the prices of crude oil, which means it's not stepping in and kind of controlling supply to support prices, and then the market kind of dropped very quickly. In addition to that, the crude oil is priced in dollars, and if dollars start to move back up, or they've moved quite a bit higher, then the per unit value of crude oil drops because, again, they're traded in dollars. So as I'm saying, it gets a little bit more complicated.
Hey, FT, before we move too far from the indices, have you heard anything else about the CME doing a micro ES?
Man, we battled on that one pretty good. We tried to go over people's heads because we weren't getting anywhere, and they're just not comfortable taking this huge benchmark product and chopping it up into something smaller that would separate people from trading it. So, they have the bigs in the pit, the bigs in the electronic, which is $250 per point. Then they created the E-mini in 1990 or 91, and they're just afraid to create a micro ES, and our push is that it's great. The ES and the bigs are great for the bigger firms that need them to hedge and so on, but we need a micro product for the smaller traders so that you don't have to have a big account to actually survive it.
Yeah, I'm surprised they would not be interested to try to lure in some of the Forex guys.
Exactly. Okay. And those guys who want to trade equity, who've been trading equities but are too scared to trade a $95,000 per contract product for $500, So. Yeah. So it's a battle, and I'd actually push to have a petition go out there for, have people sign a petition to push for it, but it's just the timing isn't. We're just told to let it lie for a bit. The timing isn't right. The CME was more concerned with fees, with data fees, than it is with
yeah. Yeah. Okay. Thanks.
It'll come though. I think it'll come. They can't keep it for too long. Tape reading. So many of you have heard about tape reading. Oh, I see a question by Arnie. Great question. What about grain, the grain market? Not suitable for scalping. Okay. Grains are very special. Grains are a little bit more like crude oil. They're supply demand based. Grains, though, can have very often have limit up or limit down moves. That is very dangerous for scalpers. If you're a scalper who's got orders out there and suddenly the market has a strong move on a crop report or some potential for a drought, or a large producer puts out a statement on their product, the grains market can go lock limit very quickly, and if you're a scalper, you're probably holding too sizable a position and you can't get out. It could be very destructive. I would suggest you stay out of the grains markets. For scalping. It just isn't appropriate. The market's not thick enough. There's still quite a bit of volume going off in the pits, and it's just a huge disadvantage to trade those electronically on a scalp basis. If you want to take a position in them, that's different, but scalping, it's not really appropriate. Tape reading and its uses. So many of you have heard of tape reading. You probably saw Jesse Livermore talk about it on Reminiscences of a Stock Operator. It's been around for eons. People used to sit in front of the ticker tape and read the prices all day long to get a feel for how things are trending and so forth. I was raised as a tape reader when I was scalping, and unfortunately, reading the tape is not as useful as it used to be when I first started. Tape reading was great because back before the CME decided to break up the information that's on the tape, it used to be that if I was to sell 500 contracts on the bid on the ES, you would see a red print for 500 at some price. And my entire order is shown as 500 hitting the bid at one price. You did not see how many people it took to fill in that 500 lot order. But what they did in 2005, I think, what they did is they broke that up and then started to report the supply side. So instead of seeing the 500 hitting the bid, what you were seeing is a whole bunch of 1s and some 10s and 12s and 20s and so forth that filled that 500 lot. And so there was no longer any advantage to reading the tape in that way. I still use a tape feed on my trading platform. It's also known as time and sales, or a tick stream. I use it just out of the corner of my eye to see what the velocity is of the trades going off. It helps tell me when the market's acting frantically or whatnot. But it's not something that is readable. In the past, I would filter for 399 contracts, and I would see red or green prints, and it would just give me an indication of which side was more aggressive. If a 500 lot hits and then it's followed by a bunch of buy orders for 2 and 3 lots and 10 lots and 20 lots, and then 500 lot hits again, I know that there's a supply there, and I want to look for areas to get short on a scalp for when the buyers are no longer able to absorb that size anymore. But now that 500 lot just shows up as a whole bunch of 1 lots and 20 lots and so on. You just cannot see it. And so the tape is not as reliable, although the velocity of the tape still is. What has changed that makes it more difficult to read? That's what I just explained. How long does it take to develop this skill? It took watching tick for tick all day. It took me close to a year to start to see patterns in the tape. It really takes a long time. It is not something you want to sit there and look at for 2 days and draw conclusions on. It's just not enough. And to be frank, it is not as useful anymore. It's just much more important for you to have a bias based on sound research and sound ideas, probabilistic thinking, and then to start looking at areas you want to trade, and then maybe use the support of the tape or the tick stream to see how fast the market is printing opposite your direction. If the market's moving into an area that you want to sell, for example, I want to see it move very quickly, and I want to see it the tape start to slow down, and I want to see it struggling to print before I'm looking for a chance to get in short, for example. That's just an example of how I would do that. But other than that, it's really not a very useful skill for scalping anymore. Basic risk and position management for scalping. Okay, this is important. Again, before I get into the exercise of taking on and managing a position in front of you here on a market replay, we're going to select a random day, and I'm just going to pick a spot and just scalp, win or lose. I want to make my opinion on a few things very clear. Scalping is not for everyone, okay? Without emotional awareness and discipline, scalping is truly just gambling and has the same edge. Scalping is not for everyone. It requires really hardcore discipline in order to take this on. A scalper can under no circumstances violate an exit. You cannot decide to give a trade a little bit more room because it's working against you and because it's taking away all of the effort you made in the morning in this one trade in the afternoon. Can't have that happen. It will happen, and hopefully it'll be painful enough that you won't let it happen often before you stop doing it. Collecting many ticks over many trades and then losing points in a couple of trades is just not sustainable as a business. Do you have issues maintaining discipline? That this is not for you. You really, I cannot emphasize enough the importance of being someone who just does what they plan to do, does what they say. Basic risk management. Scalping is fluid. It's not something where you can sit there and go, I'm going to get in here for a scalp and I'm going to put my stop below the last low or whatever. It's scalping is much more about, think of scalping like you would if you were a musician who shows up and there's an orchestra already playing and you tune in for a bit and then you just join with your instrument. Get into the flow, get into the tempo and all that stuff. and then pick your spot and then start to flow. Scalping is about reading the continuous stream of information of pricing and volume, and then just kind of getting in tune with the wave of movement in the market. It is a very fluid way of trading. It is not a structured way of trading. The only structure you can create, in my opinion, when you scalp is that sandbox that I talked about, setting your limits, setting your time, setting your size, setting all these things, and then just kind of flowing with it. It is therefore difficult to define an exact exit prior to entry. Be clear about what to do with trades prior to important news releases. Be clear about when to trade after an important release. Instead, scalpers define a general loss limit per trade. Instead of having a preset plan, they define a general loss limit per trade. I generally have a loss limit on my scalps where I say, if I violate this, I'm done and it's over. But more importantly, scalpers define a loss limit per day. You have to be in the flow, and a lot of times you're the last to know that you're not in the flow. So having a loss limit's like having a seat belt on. We don't put on a seat belt with the intent of driving into another car or into a concrete wall, but we have it on for when we don't plan, when we didn't plan on things happening, and that's why loss limits are very important. I rant about this all day. I watch the risk here at Stage 5 all day long, and people just say yeah, and then they don't put on a loss limit, and then they force me to put that on for them by calling them and telling them if they don't get out, I'm going to take them out. It's not a fun thing to do, but it's really difficult to tell whether or not you're in the flow. And there are days, I don't care who you are and how much practice you've had, there are days where you're just going to hit your limit. It's just, it's like pulling cards out of a deck of cards. Sooner or later, you're going to pull a joker. You know, it's in there. It's going to happen. So have a loss limit and obey it. Stop for the day and spend the day doing something else productive. Let the market do what it's got to do. Come back tomorrow with a new clear slate. Just like scalping, risk management's very active in this approach. So I want you to look at something here that's pretty unique. I want to share this with you. It's how to manage risk with size. This is a regressive trading strategy. This is what I used with my traders and my prop shop. So I'm going to create a scenario here for you. I have not shown this before. It was strictly proprietary. But let's say your default size is 4 contracts. Very reasonable for this group. 4 contracts, the threshold size, which means that the smallest increment of size that you will change your regressive sizing by is 1 contract. It's preset in your risk plan, and this is written that your regression is 1 contract per 25% towards a daily loss limit. Daily loss limit's $1,200. Okay, so here's what happens. We get in here on the first trade. The pink has a scale on the right. The pink is the size you're trading. The blue, this light blue color, is your running P&L. Okay, and the scale for that is on the left. So you get in here, in the first trade you lose $300 on 4 contracts. What is that? That's 1.5. That's a 6-tick stop on 4 contracts. You've lost $300. Okay, immediately, because you've lost $300, that's 25% of your loss limit, you drop 1 contract. So now you're trading 3. This represents 3 contracts right here. You're dropping it to 3, and you're going to trade a 3 lot at this point. So there's your 3 lot, and then you lose $200. Okay, you stay at 3 because now you're down. No, you lose your P&L, you gain $100, so fine. Then you trade a 3 lot again, you lose that $100, down. You trade your 3 lot again, you lose $100 again, and you're at $400 down for the day. This is your equity curve. Your 5th trade, you trade your 3 lot again, and you're down $400. And then on your next trade, you're losing $200 more. You drop to 2 contracts. And so what happens is, as you drop, as your P&L drops, your size drops. So as this goes down, your size goes down as you approach your loss limit. The loss limit is down here. It's $1,200. And so as you approach your loss limit, you're regressing down to 1 contract. So at $900 down, you've lost 3/4 of your daily loss limit. You're dropping 3/4 of your maximum size, which was 4 contracts, which leaves you with 1 contract. So as you approach your loss limit, you start to trade 1 lots. And as you come back, you're doing a lagging regression, which means that if you gain back 25%, you stay at the lower value. You have to gain 50% to trade 50% of your size. You have to be at 100% to go back to 3 contracts, and you have to be above 100%, which means positive on the day, to go back to 4 contracts. Why? Why do we do this? Can anybody answer why we would do this instead of the old, what's it called, anti-martingale strategy, where the more you lose, the less likely you lose, and so you increase your size as you take more trades? Right. The goal here is to stay in the game. You are not in the flow of the market, so you want to stay in the flow. You want to gain that flow. You're essentially battling to regain flow back into the market, and you cannot do that on full size. You don't want to go back to 1 lots right away just because you lost on your first or second trade, but as you approach your limit, you want to drop to 1 lots, and the goal here is never how much can I make back. That's not the goal. The goal is to get into the flow and see what the market does. The more you trade, the more samples you have. 1, 2, 3, 4, 5 samples. The more samples you have, the more chance you have of finding yourself in alignment with the movement and making better decisions. So as your P&L drops, you want to be at 1 lots, and you always want to hit your limit with 1 contract. And I'm going to tell you this: if you were one of my prop traders and you're sitting here hitting your limit on full size, you're in trouble, because you're just wasting my money. I don't want you wasting my money. I want you to take, if I'm going to lose $1,200, I want to lose $1,200 on 200 trades or 300 trades or 100 trades. I do not want to lose $1,200 on 3 trades. That's just a waste of money, and that means you're sitting out tomorrow. Okay? So as you get the flow, as you see here, gets down to $900 down for the day on 1 lots, and starts to kind of make some back. Ooh, made $100 back on a 1 lot. Good. This trade was a scratch. Made another $200. Okay, bump it up to 2 contracts, and made another 100. Good. Now you're at 400. So now you've gained back some of the losses. You're below 500, below 50% of your daily loss limit, which is $1,200. Now you can bump up your size to 300, and you fall back below it. You just lost $200. Well, you're bumping your size down, and so on and so forth until you find your flow. Once you find your flow and you're positive, now you can crank it back up to 4, and now you can do something with your day. Most everyone I know, and in my experience as a under the brokerage side of things and seeing a large number of accounts trade through us, in my experience, pretty much everyone hits their limit if they have one. Most people do not, despite my constant rants. Most people hit their limit on the highest possible size. Okay, and it's because they bottom, boom, they splat. They get a call from me, and you need to get out. And they're doing it on the worst size possible. That is, no offense to anyone, that is the amateur thing to do. It's not wise, because what happens is you're chasing profits. You're increasing your size as you lose. You're trading more as you lose because you don't want to lose. And unfortunately, adding size makes you lose more. You want to cut your leverage as you're out of alignment to the minimum possible, and then want to pick it back up as you gain alignment with the market, and then do something with the day.
FT, I've got a quick question for you. You know, I don't scalp, but okay. What if someone is scalping, and let's say they loaded 4 contracts, okay, and it's going against them, and you know, human nature, psychological response, this scalp is now turning into a longer term trade, right? They're hanging on to it, okay? Are you advocating? I mean, aside from that being a problem to begin with, are you advocating that that person start peeling off? You know, as it goes against them, they should scale down to 3, scale down to 2.
Absolutely.
Okay.
Yes, absolutely. It's the same thing, Mike.
Right.
It's the same thing. You want to, so what you bring up here is the reason I'm recommending this book called The Chimp Paradox, okay? This is an awesome book. I read it several times. It helps scientifically explain why we do those things you just described. The name of the game, I'm going to put this bluntly to everyone here. The name of the game in trading, whether it's equities, futures, whatever, is to maximize your sample size. It's to maximize your sample size. The only way to do that is to minimize your risk or control your risk as much as possible. It's the only way you can maximize your sample size. So this person who's started out as a scalp, turned it into a short-term trade, turned it into a swing, they cannot regain objective perspective on the market, and we've covered this in other webinars on BMT. You cannot regain objective read and objective analysis on the market with that position in mind. It's right. It's like going into the deep south and telling people that guns are no good and the Democrats are awesome or something. It's ingrained in them to get angry about that idea. It's I'm just being facetious, but it's hard to regain it. The problem is that as the market causes pain, your ego is defending you. There's a program that kicks in that defends you from harm, from experiencing more pain. So you stop logging into your platform, you stop looking at your statements and so on. The best thing you can do is minimize it, and it helps you gain a little bit more perspective when you minimize. Look, if a position's going against you, minimize the size. You want to hold on to it, you turn it from a scalp into a swing, hold on to it, fine, minimize your size, put the size back on once you see evidence that it's turning. Go ahead and put your size back on. It's fine. At least you're minimizing the equity draw when it's at its worst. And what's worse is usually you'll get out at the bottom completely, you know?
Right.
So it's better to minimize it because it gives you some perspective.
What's the
$200 a tick, now you're losing $25 a tick, and you can be much more objective at that rate, you know? It's
basically the same thing, the same philosophical or psychological response that people have trouble with scaling into winners. You know, it's really easy to scale into losers, okay, but it's very difficult to add to winners. It seems like, I mean, for me personally, that's something that I had an incredibly hard time learning to do. And once I finally started doing it more consistently, I, increased my profits. But it's so hard. It's so hard to add to winners. And, I don't see anybody else doing it. I don't want to sidetrack. Sorry.
It's counterintuitive to add to winners. But you know what? The scalping example I'm going to show you, if the market gives it to us, like I said, I'm just pulling up a random day. If the market gives it to us, I'll show you how adding makes a difference and why I add. That's part of the exercise that I'm going to show you here in a minute.
Okay, a couple questions real quick. Josh is asking, hey, FT, does this mean that your max loss for one trade in this scenario is 25% of your daily loss?
No, the max loss in one trade, no, that's not necessarily true. Because you can take up, it's with scalping. There's really no set max loss. It needs to be a lot better than that. In this scenario, as your size gets bigger, your account gets bigger, your daily loss limit can get bigger, and there's a lot more room to cut that down, to make every trade only count for maybe 10 or 15% of your loss limit. But unfortunately, in this example, and this is kind of a real example of what's typical for a prop trader, it is 25%. But the goal here, the goal of this, is to show you that how you should regressively manage your risk. How to cut it's necessary to cut size to just stay in the game and extend, make that loss worth something over time. That's all I'm looking for.
Right. So if you're a scalper that's doing 20, 30, 50, 100 trades a day, then obviously it would be to your advantage to make sure that you can sustain a string of losers. I mean, if you run just a simple Monte Carlo analysis on your trades, then you'll find that you may have a large number of consecutive losers without doing anything wrong, right? And you don't want to get out at the bottom and not be able to continue participating.
Correct. And so the only thing you can do is keep taking the next trade. That's why systems are kind of prevalent in the market, is that they don't get emotional about the trade. The only thing you can do as a trader, I'm telling you this, the only thing you can possibly do as a trader is take the next trade. And if you're already down, then chances are you'll start to get picky and make excuses or see things that don't exist. Instead of just putting on the next trade as if it's your first. Cutting down your size is another thing that helps you do that. Look, I lost on 4 contracts, I'm down to 1 contract. How harmful is that going to be, how painful is that going to be to just put it on and take a $50 loss if it doesn't work, So that's another advantage.
I sure wish people would think that way, but unfortunately, and you know this better than me, I'm sure, people only focus on trying to make back what they've lost instead of trying to protect what they have.
And they can only see the upside to the next trade. They have no idea what the downside consideration is,
Yeah, you and I joke about how many Excel spreadsheets have been created that show how much money someone's going to make, with all these compounding contracts. And I never see an Excel spreadsheet that talks about risk. Anyway, sorry. Justin's asking a question. What's the formula to figure out the daily loss limit?
That's a little bit more complicated. Generally, a new prop person does not have any history, and generally it's set at a fixed amount. In general, what I did was I would put $25,000 up, and their daily loss limit is $500. So it's about 2% of the account. If you hired someone and they lost $500 every day on $25,000 and they had to stop trading on the last $500, how many trades they can take, and compare that to those people who would allow themselves to take a $2,000 loss, and you'll see that having a 2% limit gives you a heck of a lot, because it's a parabolic curve, and I've demonstrated it here in another webinar about risk. It's a parabolic curve, the bigger the percentage, so you want to keep that percentage as low as possible. That's why opening an account for $5,000, whether you trade equities or FX or whatever, $5,000, that's already a big strike against you. That's just not enough equity to effectively manage risk. We open $5,000 accounts, but I push those people to trade micro FX products or products that are very, very small, for that reason, so that on a micro 6E contract, a micro euro, a bad day is $30. You've hit your limit for the day, and it allows them to come back and kind of refine their skills in a live market as opposed to a simulation. So 2%, 2 to 3%, and as you lose, that percentage goes up to about 5 or 6% of your account.
Let's do one more question before you show us the demo. Brandon has a really good question, I think. He's basically asking, what's your advice on if he doesn't want to start out, like in your example on the screen, at 4 contracts at the max size for the first trade of the day, but he instead wants to put his toe in the water, maybe start smaller. How does he ramp from there? What's your advice was starting small and then scaling up throughout the day?
So, here's what I've run into this a lot. We've thankfully had a good number of people, a decent number of people through stage 5 who started to actually see some results for their effort, and I've been getting that question. Generally, I don't like giving anybody $500 margins on U.S. equity indices. Others, our competitors, give $400 or $500 margins. We generally start people at 50% on all future products. It's not to limit them. As a broker, we want them to trade more, so we want to minimize their margin and just watch the return.
Hey, hang on. I'm not talking. Not margins. Talking about.
Yeah. No, I'm getting to it.
Okay.
How I'd like to address it. At 50% margin on the ES, that's around $2,500 per contract. Earn the $2,500 to add another contract. Then you earn another contract for every $2,500 you put up.
Right.
You reduce your size by one contract for every $2,500 you lose. That's how I would do it. Stay within your margin requirements.
Right. But let's say that someone has earned the right to trade 4 lots, okay? But they don't necessarily want to sit down in the first trade that they put on 4 lots. Maybe they aren't comfortable with whether or not they are in sync with the market. Do you have advice that you have, mathematically proven that it's better to do X, Y, or Z in that case?
So what I would do is on days when a person hits their daily loss limit, including myself, the next day you don't sit out. You need to trade, and what we do in that situation is we would start at the lowest size possible, and the goal is to build a base. So if you normally trade 4 contracts or whatever, you might come in and trade a 1 lot, put up some gains, and then move your size up. So if you're not comfortable starting with 4 contracts in the example provided here on the screen, fine. Start with 1 contract, make sure that you're in the flow of things, and then up your size at a certain limit. Say for every $200 you put up, you'll increase your size to the maximum that you normally or want to trade. But it's better to control that with margins, really. I think that, yes, you might have a $50,000 account and you're capable of, you're allowed to trade 20 contracts. It really isn't smart to trade 20 contracts. It's better to trade 2 and do something with 2. And 2 is really a minimum in futures because it allows you to scale out and reduce your risk. Start with 2 and then work yourself up to 3, and if you're having a good day, stay at 3 or go to 4, but don't push the limit. This is why I started to answer the question by using margins, but I wanted to clarify, margin is there as a measure of risk, so use that to kind of size up what you're doing. It's important to go that way.
Right.
I don't know. Does that answer your question?
I think so. He said yes. So
okay.
There's some more questions, but I think it would be better if we went on to the examples and then came back to kind of
I have quite a bit to cover still. So.
Yep.
Okay, cool. All right. So we looked at regressive sizing. So we use that for scalping a lot. Managing risk with size is another one. It is when you basically are using the leverage that you have to manage a position that's already in play. I'm going to caution you, this is a very advanced trading technique. Many people mistake managing positions with size with averaging down or averaging up. Do not average down or up. This is a planned play where you're basically adding the most size after the trade has gone against you a certain amount of distance. This is generally done in a consolidation zone or zones. The scalp starts with a feeler, so you put out a 1 lot, and then you see how the market's kind of responding to that 1 lot. It gives you, it's one way to really get into the flow of the market. I used to come in in the DAX, and I would just kind of sit and do my prep, and then I would just put a 1 lot. out there at some price, long or short, and I would see how the market responds to that one lot, and it sets out for me how the flow is. You would see the market go through it, go against it, go up for it, go against it, go through it, but generally it hasn't gone anywhere, and it would tell me to just scratch that trade or take something off or take a loss and just sit out. That's called a feeler, and what happens is if the feeler starts moving your way, then you start to really become active in that direction. That's managing trades with size. Okay, you'll hear scalpers say that a lot. Basic scalping techniques: know your time frame. Okay, it's important. Know when you're wrong. Very, very important. Don't overstay any trade. Even trades that work in your direction, you're not a swing trader, you're a scalper. Don't overstay it. Wait, don't sit through a market pullback when you have a position that's going your way. Close it, let the market pull back, jump back on, or even better, if you're very, very good at this, then you would trade it on both sides. Manage your costs, which I covered hopefully thoroughly enough, how to reduce your exchange fees and so on, and what your cost structure needs to be. Choose a simple bar structure to trade off of. It could be a moving average crossover. I don't recommend that because of the lag factor, or maybe a stochastic setup on a very, very short time frame, but choose something that you can consistently queue off of to execute those plays. Let's take a look at a sample here of a trade. I'm going to play back the market at high speed simply because we don't have all day. Although many of you are trading fanatics and probably wouldn't mind sticking around a while, but I'm going to try to make this as quick as possible. I'm picking a random day, if I can find the replay bar. I'm picking a random day between, let's see, October 13th and October 20th, just when we've seen some action. The program is resetting. The Trade Analyzer is a tool that I developed a long time ago that I used to scalp off of, and it was available to my prop guys, and it's available to Stage 5 traders. This new version of it is running on Ninja as an indicator, so every time you change your chart, it actually resets. Unfortunately, that's a hard-coded thing with Ninja. This is the Trade Analyzer right here, and it's running off of this chart. This is a 3-tick Renko chart, and just a standard Ninja DOM playing market replay data. So let's forward through here to maybe a time where there is some action. Sorry, it has to process this information every time, and it takes a while. Hopefully it does not implode. It's just processing my requests. I just chose a random day here. Okay. So here we go. So what we have here is the theoretical average. This is a very important number for me to trade off of. It tells me what position I have on, long or short. MFE is maximum favorable excursion. MAE is maximum adverse excursion. How much the heat has gone, how much the trade has taken. My best scale out so far. The MAE, MFE is in ticks. So if I'm holding 2 lots and it goes for me two ticks, the MFE or MAE will be 4. BSO is just a number of ticks from the average I've taken. So if I've bought at 94, got out at 95, it'll show 4 as my best scale out. If I get out at 96, it'll show 8 as my best scale out. Time in trade is self-explanatory. And then this chart, this has all these other statistics, which we'll go over in a minute. This is not a demo. I'm not a sponsor on BMT, so I'm not taking the time to demo a product, but I'm showing you something that I use constantly and is an integral part of how I trade. I'm going to speed this up to about 8 times. So I'm looking at this and I'm seeing that the market has come down. We've switched to a new session. I'm trading after the European close here at 10:30, so the market's likely to slow down a little bit. Looks like a consolidation day, and I'm looking for a scalp. Okay. Looks like we had an impulsive move down. We have a continuation move, which turned out to be another impulsive move. We finished that, and we're in a corrective mode. So the trade is likely to be a long here. Looks like we're trading October 13th at 10:53 a.m. This is not a pre-recorded or I've not looked at the chart before. I don't remember exactly what it did at this time. Remember, I'm looking at a very, very short time frame. I'm not used to Ninja. So I'm going to put a feeler out. Here's my feeler, 1895.50. So it's going a point against me, a point and a half. There's 8 ticks, 2 points on a one lot. This is my feeler still. I'm looking to see if the market has another bottom of it and will turn. There it is turning. I'm going to add. My average is 95.50. Again, I'm looking for this to break. If it does not, then I'm out. Looking for it to turn. Is this coming across clearly, Mike? I don't know. So there's a scalp that did not work.
Looks good.
And that's fine. So I lost 19 ticks on that. I took 20 ticks of heat. MFE is only 3 ticks. I had 2 contracts on. I was on for 5 minutes. So this is failing. So now I'm going to look for a pullback, and I'm going to look for a sell. These are not my normal charts. I like to have a zigzag here that tells me what the rotations are. I don't have that in this product. I don't generally use Ninja, so I'm looking for a pullback to sell here. This is not moving fast enough. Might have to speed it up some more. Short. Again, a feeler. How is this going to be treated? I'm okay with this trade going against me all the way up to about 96. This is not my real trade. This is a feeler. See how it comes back? See, the feeler's telling me that sellers are still trying to take over here. The reason I'm looking short is because this rotation here was larger than the other rotations, and the market came all the way back. I expect it to drop probably in the 88 area, and I'm going to add to the short if I get a chance. So I'm seeing 9 ticks of heat, 3 ticks of MFE, taking too much heat here. So I'm going to look for this to rotate back down, and I'm looking for a break of this 92. So I'm going to work the 92 already. I'm looking for a rotation down here. Again, I'm missing a lot of information on what's happened before and where we are. I don't have a profile or anything to work off of. So this is basically pure feel. Looking for this bar to finish here. Looks like I'm in the middle of a chop zone. See this? I'm looking for this bar to go lower, and it did not. So I need another bar to do that. This looks like it's not working again. So poor start on the day here. But 98 was the last high. This can still turn. I was trading this leg here, and it looks like it's failing. There. Okay, so this trade is not working anymore. Take the loss. It's over. Okay, still working the 92. I'm going to cancel that. So I played the long side on a pullback. That didn't work. Rotation down is more than 50% of this rotation, so I was looking for the short, and we have a break higher. I'm not a part of that. I got out of that at 99.75, and it's at 1903, so I basically saved myself about 4 points on the loss. You can see here that I'm taking quite a few losses, but it doesn't matter. These are one-lot feelers. I'm going to say that the maximum I'm going to carry as a position is a 4-lot, but I have not been able to get these 1-lots are not going to matter once I get something going, and the goal here is to get a good feeler and a good run, and then pile on and see the gains in it. So the losses that I have now are probably something that people are like, that's a lot. But really, when I get the trade going and I get something going that is good, that won't amount to much. Those 48 ticks won't amount to much.
Well, you're putting yourself under a lot of pressure to do this in front of everybody, especially without any of your regular charts.
It doesn't, it doesn't bother me. That's the only thing that bothers me. It doesn't really bother me, really. I've traded in front of my traders a billion times, but the only thing that I'm at a disadvantage here with is that it's an unfamiliar trading platform, but I also don't know what from yesterday I can trade off of. Like, I don't have a profile or anything that tells me where the volume came in. See, I'm going to take the short here again. This is an impulsive move that I expect to complete, so I expect this to extend to about 1907 or so. Remember, these are scalps. I'm not taking a position in the market. I'm looking for failure. Added to 1903.50, so I'm short 3/4 and 325. So I'm looking for failure here. I'm looking for 92 to 05. That's about 13. 6.5 is 8. So I'm looking for an 8.5 test. Looking for another failure pattern. There's another failure pattern added at looks like 1902.50. My average is 1903. I'm going to scale a little bit just to improve my theoretical. My theoretical is 1904.25, so it has to go to 1904.25 for me to scratch a trade now with my theoretical average. My MFE 31, negative 31 MAE. This trade's starting to turn. I want to add to it. This is likely to pull back to 1903 before it fails again into 98.5. Again, I don't know what's going to happen here. I'm just looking at the bars and trading off of the bars. I'm missing a tick stream and the market flow. I want to see the MFE extend more. So here's it's likely to drop below 1900 here with this pattern that we have. Just waiting for it. Consolidating at the 1900.25. So I have what looks like a zipper formation here. If this pops through the 1902.25, I'll close it and I'll get short again. Looking for this pattern to fail. There it is. So that pattern failed there. I do not want this all the way back. So I'm going to look for another short, but it's not ready for that yet. So there I only gained 7. You can see the stats, MAE 35, MFE 31. And then we want to save those stats and study them later. Looks like the continuation pattern is going to take place here. Looks like it's going to go higher. Very, very shallow pullback on this impulsive move, so I'm looking for another leg up. Sorry, I can't. It's not like one of those cooking shows where I have a turkey already made up. There's the, okay, now it's failing. So on to the next trade. So I'm looking for what happens here at 98, 97. So this is what I was looking for. This was the 98 exit that I wanted earlier. Okay, so now we have another failed pattern on this impulsive. So now I'm going to look for a pullback to the 1900 and short that. And then the target would be 88 or so, if it gives us that chance. Like I said, I did not pre-practice this. I'm just going off of this naked chart. Probably should have pre-practiced this.
So, talking about the rotations for just a second, you've done a webinar on this in the past where you showed everybody how to go into Excel and how to pull out these rotations and everything. But is this what you have in your mind? These preset moves that you're expecting to swing high, swing low a certain amount?
Yeah, see, this is all the information that I'm missing here. This obviously this is not the same day. This is the current day. When I see a rotation like this, when I see us come out of 2.75, 1.5 point rotations here, and it breaks down slowly, and then I see a move like this, I'm essentially trading long in here. I'm looking for a long in here and shooting for the continuation pattern on this impulse. It is not, generally the market does not move in an impulse and then move all the way back. It generally moves in an impulse, pulls back to some degree, and then has a completion or an exhaustion move. This is what we had on the close today. So I expect that the overnight session, that's already done that, the overnight session will have a continuation move, and it did, to 39.75 today. But being able to see where the LVNs are, being able to see where the prior day is, where the initial balance is, those are benchmarks that I need to be able to cue off of as far as what is likely to happen next. And I don't have that information right now. So I'm trading kind of blind here because I don't have a profile, but I'm going purely off of the rotations. In fact, this is the rotation up I was looking for. I said we're likely to revisit this 1900.
So I know you're concentrating, but if you have a second to give us a definition of a
Sure.
impulsive move, or I think you just talked about responsive buying or selling.
Yeah, an impulsive move is essentially so the ebb and flow of the S&P 500 on the time frame that I use, which is about a 1 minute and a short-term Renko, is about 3 to 4 points. When the S&P all of a sudden has a large move in any given direction, and it's like 4 or 5 points, that's an impulsive move. And so there are two ways to trade that. You either trade the continuation. So if you have a 5-point move, generally the market consolidates and then starts to continue with a 2 to 3 point move. I'll take advantage of that. Or what it does is it makes a 2 to 3 point move beyond that 5-point move on the pullback, and then it starts to fail or correct. Might get something here. it might, and then it starts to correct, and then I'm going to trade the correction. Like here, you had this impulsive move, and I traded it from the long side. I tried to trade it from the long side, and that failed. Generally, you get another move to finish this, to exhaust this, and then it starts to, and then you would get this move down, and then this move down, being impulsive, generally stays within the 50% or so, and then you have an additional move down lower. And it's right now it's not behaving that way. I'm trading the lunch period. But that's one general pattern. That pattern has a probability. I'm going to add to this scalp. That pattern has a general probability for how it plays out, and it's in the 70-ish% of the time. That's what the market does, and that's enough for me to build on. So here's another failure pattern. You saw I got short, and then it failed, and then it tried to go higher, and it failed again. So now I have another failure pattern. There's the 98 that I wanted to exit at earlier. I want to get out before this low, so 95.5. Oops. 95.5. Where are you? Man, this dome pops around a lot. There. So now I have 51 MFE, 16.
Sorry. I was going to say you should use the static dome. It doesn't move.
Yeah, I know. It's like I'm just not used to this. Not sure if I have a static dome in this or not. Maybe it's a standard thing. I don't know. I don't use Ninja. That's why. So here's possibly another failure pattern. So I'm going to add to this. My average is 1950 based on the theoretical. You see how my average on the screen is 1900, but my theoretical is 1950. 1950 is the correct average. If I get 95.50, which is this last low, look at this average, 1903. This two-lot position has to move to 1903, way up here above the last high, in order to for me to lose on this trade. And so I'm managing my position now with the theoretical average. I have 76 ticks MFE, 19 ticks MAE, and I'm just constantly looking for failure patterns, and this is what's called campaigning. I've got a core position on of 2 contracts. I trade a different size than this, but I'm constantly looking for a failure pattern, and I'm adding and taking off based on that failure pattern. So if I get short again, I'm going to work 94.5 ahead of it. Oh, they're about to take that out.
The theoretical average is from flat to flat, is that right?
The theoretical average is simply taking into account all the profits that you've made on the current open position.
Right, so when you're flat, it resets. So
yeah, it goes to 0.
Right, so it's, okay. So it doesn't matter
right now,
the size. It only matters once it's flat, and then it'll start over. And then once you put a trade on again, doesn't matter if you trade into it 100 times, it'll maintain the average.
Correct. But that's per trade. So the theoretical average is recomputed and is equal to your average on your platform every time you initiate a new trade. So right now what this means is with this one lot has to go to 1912 to wipe away all the profits I've made on this trade with up to what position I had, maybe 3 or 4 lot. So this trade has to go way against me to flat out. So if I get out at 1900 here, which is what the dome is reporting to be my average, that's not really my true average. My true average now is 1912. So now I can relax and look for another failure pattern, which we're about to get here.
Right. So
see how this average dropped again to 1904.75. It's taken into account that I just sold at lower price, and therefore my average is not as advantageous. As I take a profit on this last ad, that 1912 might become 13.5. Yeah.
So just so everybody's following with the terminology, you're defining a trade as when you were flat, now you're not flat. It doesn't matter how many times you scale in or scale out, take profits. It's a trade all the way until you're flat again. Flat
to flat. That's a trade.
Yep.
See this 12.75. So essentially with that additional contract that I put on, it went from 1912 to 12.75, which means I gained 3 ticks on that additional contract. That's how it improved my position. This looks like it's done, so I'm going to close this trade. I'm flat again, and there's your summary. See how one trade with good risk control, just to getting out, once things happen, you're in the flow. One trade with a max of 2 lots. That's the most I've had on at any given time. I'm able to recover even though I've traded, I've taken big losses. 2 lots traded, put on and managed properly with risk in mind is able to repair the position that I was in before I entered this trade. The rest of these stats, and that's the next part of my talk, and I know I'm really running over my time here. These stats are maybe not so important right now, but these are for the day. But they're very important when I have 300-400 trades to be able to see how often, what's my average loss or scratch, what is my expectancy. My expectancy is 7 ticks per trade. It's very important for me to know that over a large sample. Here's my peak gain at 28. That's the best I did today, is 28. My max drawdown, peak to trough is 29. How efficient am I in taking profits out? 79%. That's basically telling me what the efficiency is. Average duration for my wins is this long. Average duration for my losses is this long. This is the percentage of time I took a BSO, and so on and so forth. I can export this into an Excel sheet, and now it's stored in Excel.
I have a question. I don't mean to put you on the spot, but it's not going to stop me. Do I have to run the what is this tool called? State S5?
Analyzer?
Do I have to run it, or is this like an automatic thing that's going on in the background that you could email to me every day?
Yeah. It's an indicator. This is something you run on your machine. It's an indicator. It has a license. Anybody that has an S5 account will be licensed to use it. It's based on a machine ID, and you can turn it on as an indicator. So if I go to my indicators here, it shows up as the S5 Trade Analyzer. That's a disadvantage, but that's just how Ninja works.
So this is not sorry, this is not a broker side thing where if I forgot to turn it on, I can't retrieve these stats.
No, you can't. You can you cannot in the Ninja version, just because you have to run it as an indicator. In fact, if I change this chart right now, if I change the periodicity or add an indicator, all of this goes away. Yeah, it's unfortunate, but that's just how Ninja works. In the other version, the S5 Trader version, it actually pulls the stats right off the server, so you can actually you can log in from home at the end of the day. As long as the session hasn't ended, it'll be able to pull in all this data, and you can work on it from there.
Nice.
And so the rest of these are just showing you your performance overall. Here's your MFE MAE chart. Took a lot of heat on those earlier trades. This was a 50-50 trade, and you can see that my risk was skewed to the positive side on this trade. Here's my cumulative P&L. My win-loss, I want this blue to cross the gray and be in the positive. And here's my expectancy. It was negative for a while and is now turning above the 0 line. And these are my durations. My average win is much higher than my average loss, which as a scalper, that's what you want. Anyway, I hope that's a decent example for just basic scalping. You can see how many maneuvers I had to make in this tight range, and that's fairly typical of scalping. A lot of people find it very stressful to scalp because you have to get in and out of the market. But you know what? After a while, it just becomes like breathing air. It's just like walking. Learning to walk is a lot of falling and tripping, but after a while, you don't even think about it. And this is the same, as long as you maintain your risk control. Okay. Let's get back to this so we can finish up. Is that all right?
Yeah. Good job, man.
The importance of tracking your effort. Keep a daily summary log. So important. The Trade Analyzer or whatever tool you want to use, just keep track of these stats. You want to basically be able to see over time what happens, what is happening to your overall equity, to your expectancy curve. Some of the things you want to track: how much MFE are you getting per unit of? Oh, this is supposed to be MAE. MAE, sorry. So we're looking at how much favorable excursion per unit of heat are you getting? This is what's called this is a kind of a classic way to describe expectancy according to Van Tharp. Van Tharp describes expectancy in terms of risk. Is your system creating a 1R return, 2R return, 3R, meaning 3 units of gain per unit of risk, or is it less than 1, which means you're taking more risk than you're getting in gain? You want to keep track of the MFE, MAE. How often do you get a scale out? If you're getting a scale out, if you're getting a lot of scale outs but are still experiencing a negative expectancy, then what you want to do is adjust your trading scheme so that your scale out, your normal scale out, would contain most of your profit taking, and then you'd have a runner on to improve it. What is your percent return? What is your overall expectancy in ticks per trade? What time of day is most profitable? What day of the week is most profitable? What is your actual expectancy? Is it rising? Is it flat? Is it declining? All of these are important. You're like an athlete or a baseball player. You know, they have those baseball cards with all your statistics in the back. That's basically what we do as traders. Last thing I think it's near the last thing I wanted to talk about. Let me see what the agenda exaggerated. Okay, this is the last item I wanted to talk about. The impact of trading errors. Man, I cannot overemphasize this. We're going to look at Mighty Joe and his stats. This is Joe's TA stats. Joe knows who he is. He's a real person. He's with S5. Keeps excellent statistics. This is his expectancy over time. You can see he's taken over 480 trades, and that's his expectancy, which is expressed in ticks per trade. He's about break even over time. That's the actual curve. Now let's look at Joe's expectancy. He keeps track of his errors. We define error. There are about 6 errors that we define. Errors are things, not trades that you've lost on. It doesn't matter if the trade won or lost. An error is a trade where you did something outside of what you planned. Things like chasing a trade is an error. Closing a trade before your stop or target got hit is an error because you're micromanaging a trade. Getting long when you meant to get short, which is an execution error. There's just a whole set of errors, and Joe keeps track of these. He has a number that indexes each one of these, and he marks when he's created errors. And so what we've done is we take the expectancy that he shows, and then we take out trades that had errors and look at the expectancy and where it would be had he not committed those errors. Okay, an error includes taking a bigger loss than you should have. So what we do is we scale back the bigger loss to where the loss should be, and over time, all of a sudden, he goes from break even to having a 1-tick expectancy, which means that we expect $12.50 on the ES per trade as an expectancy over 500 trades. This is a very big sample, and so it's a steady sample. So here's Joe's running P&L. Okay, negative P&L on all those trades. Here's Joe's running P&L with errors removed. Same at the beginning, and as you can see, as time goes on, it's just, you know, he's had a nice run. He went on vacation, came back, he was disjointed with the market, he stopped meditating, and all these things. And all of a sudden, there's just a bigger and bigger and bigger gap between his actual P&L and the P&L which keeps track of the errors. Big deal. When you don't know what errors you're committing and how often you're committing them, you don't know how to correct that. Here's his win-loss percentage, win being green, loss being red, and you can see it's upside down. It's crossed for a little while when the expectancy was positive, but as the expectancy dropped, you could see that his wins are just much smaller. His win percent is much smaller than his loss percent. So that's something he's got to work on. But keeping track of your errors is the key element. And that's why I'm covering it here, because nobody ever talks about it. So the last thing I wanted to cover, I believe, yep, and then we had those questions.
Okay, You cut out for just 1 second. Do you want to take questions now, or do the book giveaway now?
Yeah, we can. It's weird. I guess I cut out. Yeah, I guess you want to do the questions, the quiz, or
yeah.
What do you want to do?
Yeah, let's do those, and then we'll see if there's time left for any more Q&A. All right, so guys, just have your BMT username ready, please, and type the answer to the question into the box. FT will pick the winner. I'm going to ask for your BMT username, and then I'll get in touch with you once we're done with the webinar to get you the book.
Man, this is always really stressful trying to catch the first guy or girl who answers it.
Okay, let's do. We have 5 books, right? So book number 1 goes to the first correct answer. Book number 2 will go to the second correct answer. By the time we get to book number 5, the 5th person that answered correctly. Okay, that way it's not based on how fast you type.
Okay. Cool. All right. So the first question: name one good thing about scalping. Good. Matt's got it. Matt C.
Okay, Matt needs your BMT username. And give us the answer also, FT.
The answer is lots of trades, lots of action. Rex had good answers. Sal, but they were too slow.
All right, so we're looking for the second answer next on the book number 2. Second right answer.
Name one bad thing about scalping. Second answer, David. David.
Okay.
I don't want to say his full name. It's
David L.
Off, though.
Yeah, David L.
David L. That's it.
All right, David L. I need your BMT username. What was the answer?
David L. wrote costs.
Okay, I still don't have usernames for either of those guys. I'll have to get them after. All right.
Okay.
Number 3.
Name one of 4 key time frame considerations for scalping. Oh my God. Wow. Okay, so it's what is this? The third?
Third, yep.
So it'll be Arnie.
Okay, Arnie, that's your username, so we're good. What was the answer?
1 minute. The periodicity of 1 minute.
Okay, looking for the 4th correct answer on book number 4.
Name one of the 3 key risk elements that must be in check in order to scalp. So we're looking for the 4th answer. Loss limit, John McLean.
Okay, John, I need your username. I'm trying to find that answer. What was it?
Loss limit.
I'm not seeing that answer. I need to get his email address.
Yeah, it's, I don't know if, let me see, John McLean.
John McLean.
He gave you his email address.
Man, I must be blind, or it's a couple hundred answers scrolled up since then. I'm not seeing it. All right. So, John, I need your BMT. Okay, I just got it. Okay, good. All right. So, number 5.
All right, last one, folks. When does it make sense to manage positions with size? 1, 2. No, don't see it. Hang on. Campaign. Okay, hang on. That's the first answer. No. Nobody's got it. Yeah, hang on. No one losing. No one losing. No. Wow, I really got you guys stomped with this one. Okay, so that's number 3. This is the... Oh, there it is. Doug Fogg. Oh, I'm sorry, said your name. Sorry about that. Doug.
All right, Doug. I need your username, and what is the answer?
In a consolidating market.
All right, guys, since there's literally hundreds of questions flying by, I need a favor, please. If you're one of the 5 book winners just now, give me your username one more time. Type it in right now. All right, so FT, thank you very much. I appreciate it as always. Really great webinar like it always is. I'm sure this will be a favorite on the site. I know that there's a lot of questions people had that they did not have a chance to get answered, but we're at 2 hours already. So what's the best way for them to ask those questions?
So 3 ways to get in touch. Big Mike Trading has a thread called AMA, Ask Me Anything, for my Futures Trader 71 handle. Mike was gracious enough to create that, so you can ask it in there. The other method is to go to my website, futurestrader71.com, and hit the contact button, or type futurestrader71.com/contact. And in addition to that, you can always write to info@futurestrader71.com. I get a ton of emails when I do these webinars, because I guess I open a can of worms every time, especially the one about the 50-50 outcome. So please don't send me a multi-paragraph email. I just am not able to answer those. If you want something, just to make a bullet list and ask the question, and then if it's efficient, I'll answer. But if it's like a 3-page thing, I'm sorry, I just cannot get to those. Okay? But I'm happy to help whenever I can.
Okay. Sorry, I'm still trying to get usernames. I need book number 4. I think Jim or James was his name. I still don't have a username for him. All right, guys. Well, thanks, FT, and I'll post the recording on this sometime tomorrow. And hopefully, I'm gone in November. December's kind of slow. Maybe we'll do another one in January or so. And
very cool.
Yeah. All right. Thanks, FT. Thanks, guys.
Thanks so much
for
having me.
No problem. Thanks, guys. Bye.